Hello, everyone. 8 p.m. Eastern on Wednesday, December 15th can only mean one thing. It is the final edition of Taxes and Retirement Live for 2021. Thank you all for joining me. I am Andy Panko, owner of Tenon Financial and one of the moderators of Taxes and Retirement. Again, thank you all for being here and spending your Wednesday evening with me as we wrap up another year's worth of taxes and retirement. Hope you all found this year informative. I found these videos throughout this year informative. Tonight will be a mailbag edition. So random Q&A. I have 3 questions preloaded from people who have sent things in. Everyone else, feel free to post questions in the comment section of this post. I just ask, as always, with these mailbags, for everyone else watching, please don't respond to the questions in the post, in the comments, because I can't see who responds to what. So it gets a little distractive trying to figure out what questions were addressed, what's not, and so forth. So thank you all for that. Comments are working. Here we go. Dave Fultz, happy holidays. Howdy and happy holidays. Dave Fultz going strong. So for those of you who didn't see the post, David Fultz is now the 3rd moderator of the group, along with myself and Cody Garrett. Thank you, Mr. Fultz, for your diligent moderatory services thus far. Hope you are enjoying it, and thank you very much for the assistance. Well, yeah, Mark Troutman, last one for 2021. Indeed it is. All right, dad jokes before we get going. And I just realized I wore this shirt 2 lives ago. I thought I was being slick. I tried not to have the same shirt on too close together with these lives, because when you look on YouTube, there's one video every week. So if I wore the shirt last week, I look like a slob or something for wearing the same thing. Even though there were 7 days, or in this case, 14 days in between, I still feel a little goofy now, because if you look at the videos, you'll see I just wore this one, the video before last. Anyway, I'll get this right one day. Okay, first, I went for a job interview and they asked me to state my biggest weakness in 3 words. Not very good at math, I replied. Not very good at math. 5 words. I failed right there. Next, I've just invented the first thought-controlled air freshener. It makes sense when you think about it, because it's controlled by thoughts. And finally, my wife just called me pretentious. I was so surprised my monocle fell out. One of those things. I'd like to get one. I could be like the Planters Peanut guy. Or I think the Monopoly guy may have one. Scrooge McDuck, perhaps. And any of those, stereotypical sort of robber barons, they're the ones with the monocles and some sort of like cool little walking stick or something. So that's the dad jokes. Let's see. Disclaimer before we get into it. Let me find it. Nope. Here we go. This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. Tonight, I'm just a guy wearing the same shirt I wore 14 days ago, 2 videos ago, talking about open Q&A about your various retirement, financial, and tax planning questions. Cool. Let's get rolling on the Ides of December. First question from, this is a thick one. Let me start with this other one first. First question from Faye Moton. I retired on May 31st of 2021, and I kept my exemptions at 0. Should I change it to 1? I checked the page to see if this topic that had been discussed, but I didn't see it. So, Faye, good question. I won't answer a specific question, and here's why. This is more of a general question about paying taxes. So when you work throughout your life and you work for an employer, you don't really have to think about paying taxes. It simply comes out of your paycheck, goes directly to the U.S. Treasury and or to whatever taxing jurisdiction the state you live in, if your state has an income tax. And that's it. You don't have to think about estimated payments. Maybe you overpay or underpay throughout the year and you just clean it up with your tax return. But otherwise, it's really simple. Other than the hassle of when you start a new job, you got to fill out the form W-4. Or if you want to change the tax withholdings, you got to update your form W-4. So your question, Faye, is, you worked up until May. Should you change your withholding form? Now, I don't know what withholding form you're referring to. I mean, if you retired, presumably you wouldn't have wages anymore. So your withholding on your employer's W-4 shouldn't matter anymore, because I would think you're not getting that compensation. But that aside, even if you have some sort of like deferred payout or bonus or whatever, still to happen. The broader question is, and the difficulty is when you retire and you don't have your employer simply holding taxes anymore, you got to do it yourself. And unfortunately, there's no easy way to do this. I did do a video on it. I don't remember when, but about paying taxes through withholdings and or estimated payments. There's really only three ways to pay taxes. One is have taxes withheld. And there's only a few sources of income against which you can withhold taxes: wages, IRA distributions, Social Security, pensions, annuities. There might be one or two others, but those are the main ones. That's option one, withholdings. Option two, and in those as well as like 401k plan, TSP plan, 457 plan. You can, those I lump those in with the IRAs, retirement plans. You can have taxes withheld from distributions from there. That's option one. Option two is make estimated payments. Estimated payments is where you directly pay to the U.S. Treasury and or your local state taxing jurisdiction the taxes you think you're going to owe throughout the year. You can pay online, you can pay by physical check. It all depends, but that's option two. Now that's clunkier and more involved because option one is simply easier. When you have a paycheck every week, you just have taxes withheld. It's automated. You don't have to think about it. When you do estimated withholdings, you have to consciously sit down, figure out how much tax you think you're going to owe throughout the year. Ideally, split that up into 4 equal payments and make those equal payments throughout the 4 different tax quarters. And to further complicate things, the tax quarters aren't calendar quarters. The first one ends March 31st. The second one ends May 31st. The next one ends July 31st. And the next one ends December 31st, where the due dates are 15 days after each of those. So that's option two. Option three is simply don't pay any tax throughout the year and just wait till tax return time and pay whatever's owed. Now, I do not recommend that. If you underpay by more than a certain amount, there will be underpayment penalties, which are in effect just interest for having not paid throughout the year when you were supposed to. So I'm coming back to answering your question. I swear, Faye. There's really not an easy answer to this. You have to look at your different sources of income. Are you going to have Social Security, pension? Are you going to be making IRA, 401k, retirement plan withdrawals? Are you going to have any annuities? What other sources of income are you going to have? You're going to be selling assets in a brokerage account. You're going to have rental income, self-employment income from a little side business hustle. All those things go into play, and you have to figure out what's your tax going to be on all of them collectively. Then once you have an idea what your total tax might be for the year, then you figure out, okay, do I have it withheld? If so, how much and from which source? Or do I make estimated payments? If so, how much? And there's no easy way to do that. If you're not comfortable and familiar with the tax estimation and calculation process, it'd probably be best to maybe reach out to someone, tax return preparer or something who works hourly, who can help you through this. Or the IRS has a link. I don't have the link with me, but there is something like, there's a site, a tool you can use. It takes like 15 minutes to plug through. Am I going to need to withhold or pay estimated taxes? And it'll ask you a bunch of different questions. You fill it out and it'll kind of spit out an estimate. So those are your two options. Whether or not you specifically change withholdings on any one of your individual sources of income, it really all depends. If you do withhold, it frankly doesn't matter whether you withhold from your IRA or your 401k or your annuity or your Social Security. It all goes to the same spot anyway. You kind of pick and choose where you want to withhold from. There isn't necessarily a right or wrong answer as to which source of income you withhold against, if any. So long-winded answer. There is no simple, clean answer, but hopefully you found that helpful, Faye. Thank you. Next. Linda Robinson Elms. Can you please review what one needs to consider when looking to stay below a tax threshold for ACA subsidies? Where ACA is otherwise is an acronym for the Affordable Care Act, which is more commonly known as Obamacare. What can be subtracted from gross income to determine your taxable income for that purpose? Does anything need to be added back in? Great question, Linda. So I have some screen shares here. The gist is, for those of you who are on Affordable Care Act insurance, you may be able to get the premiums partially or potentially even fully, I guess, subsidized by way of tax credits. Those tax credits are driven off your income, specifically a measure called modified adjusted gross income, unique to these ACA credits. There's a bunch of different, at least a dozen different definitions of modified adjusted gross income used throughout the tax code. The one for ACA premium credits is its own unique thing. So it all starts with your adjusted gross income. And let me share. I won't get too far into this because you can easily get in the weeds going through tax returns here. But I think this is important to know, and this will answer your question. So, Linda, if you look at your tax return, this is for 2021. This is what it'll look like this year. Line 11 is your adjusted gross income. This is where you start. This is not yet the modified adjusted gross income used for ACA credits, but nonetheless, this is where you start. I'll go through this quickly, but the typical sources of income are all included in this: wages, interest, like if you have interest from bank accounts, dividends, IRA distributions, pensions and annuities, Social Security benefits, capital gains if you sell stocks or bonds or mutual funds or whatever at a gain in a regular brokerage account. So those are all straightforward so far. Those two all go into adjusted gross income logically. Here's the big wild cards though: this other income, and then adjustments to income. And there's lots of things that go into this. So don't be fooled at the tax return, which may look deceptively simple because it's only 2 pages. A lot of this stuff is pulled off into dozens of other forms and attachments. So in addition to these things you see here, interest, dividends, capital gains, Social Security, whatever, there's also these other 2 line items that go into adjusted gross income. What are those, you may ask? Well, this is a whole can of worms. So the additional sources of income, there are a couple dozen. For example, taxable refunds of state credits, state refunds. Alimony received, only alimony received from divorce decrees that were executed pre-2019, I think it is, or maybe pre-2018 even. I have that wrong. It might be pre-2018. Alimony was taxable to the recipient and a tax deduction to the payer. So if you have alimony, taxable alimony, here you go. Business income, random other gains, rental income, farm income, unemployment compensation, and then a whole host of what they call other: gambling income, canceled debts, HSA distributions that are taxable, jury pay, prizes and rewards, blah, blah, blah. All sorts of things are other income. So you can scroll through this. This is Schedule 1 to the 1040. These are the other things of income that go into your adjusted gross income. As far as what deductions you can have to your adjusted gross income, scroll down to the second page of Schedule 1. Educator expenses. If you're a teacher and you had to pay out of pocket, you can deduct up to $250 from gross income for supplies you had to pay. Certain business expenses of reservists, performing artists, and fee-based government officials. I don't even know what that means, but they get a deduction. HSA deductions, here's where it goes. What are the other big ones? If you're self-employed, you can deduct some of the payroll taxes you pay. If you're self-employed and pay for health insurance, you can deduct some of that. If you have an early withdrawal of savings, like a CD penalty, you can get a deduction for that. Alimony paid, again, for divorce decrees executed pre-2018, I think it is. IRA, if you make a deductible contribution to your IRA, here's where you adjust it out. Student loan interest, and other adjustments, of which there's a whole bunch. I won't get into all of them, but you can see there's a lot of moving parts and a lot of things that go into adjusted gross income, Linda. So finally, once you know your adjusted gross income, now what do you do? How do you figure out what the MAGI, modified adjusted gross income, is for ACA premium? Well, you start here. Well, here's the formula. You start with the adjusted gross income we just looked at straight off your tax return. Add into it, this is basically just tax exempt interest. So if you have municipal bonds in a regular brokerage account, that interest is normally not taxable. Well, it's taxable. Well, it's not taxable, but it's included for purposes of modified adjusted gross income for ACA credit eligibility. This is doesn't apply to most people. These are about foreign income. And if you live in a foreign country, you work abroad, and you get like an allowance for housing or something, and you get a deduction for that, or expenses abroad, you have to add those back in. This one here is the non-taxable portion of Social Security gets added back in. So as a lot of you know, at the federal level, no more than 85% of your Social Security is included in your taxable income. Well, this adds in the other non-taxable part. So the modified adjusted gross income used for ACA credits is based on your gross Social Security, not just the taxable part. So add this all up, and this line right here is your modified adjusted gross income that you use when determining if you're eligible for Affordable Care Act premium credit subsidies. Make sense? Clear as mud, right? A lot of things. This is not an easy process or calculation to digest if you're not already kind of intimately familiar with tax returns. But hopefully this primer was a good start for you. Good question, Linda. All right, let me stop the screen share. And third question from Mr. Dave Fultz. Now, this is before Mr. Dave Fultz. This is when he was just a civilian. And by civilian, I mean not one of the moderators yet of this group. So not to say moderators aren't allowed to ask questions, but I probably wouldn't have taken this question if he was already a moderator. So maybe they can't ask questions. But anyway, so David Fultz, as a civilian, again, pre-moderation days, would you please discuss the tax planning window between age 62 and the beginning of required minimum distributions as it relates to Roth conversions and Social Security claiming strategies, and how to view your yearly tax return versus decision making that will affect your retirement planning 20 to 30 years in the future? Great question. Tremendous amount to unpack here. No simple answer, but what Dave Fultz is referencing here is something called the tax planning window or tax planning opportunity, or you hear different people call it different things, but it references the period of time after when your wages stop. So let's assume you retire at 60. Your earnings go away. Your income drops precipitously because your wages are gone. Maybe you got a little bit of interest and dividends from your brokerage account. I don't know, maybe you got a rental property or whatever, but otherwise the bulk of your income went away. So now your taxable income is really low. You did not yet start Social Security because you're only 60. Required minimum distributions from your tax deferred accounts aren't upon you yet. They don't start until 72. Maybe you have a pension, but you're delaying. You're not starting that until 65. So you have a lot of years, potentially multiple years of really low income. Don't let that go to waste. So it may feel nice to only have like 10 grand of income and you're just living off cash, but that's a missed opportunity. The lower tax brackets, the 10 and 12% federal tax bracket, which are going up to 12 and 15% respectively in 2026 when the Tax Cuts and Jobs Act expires. Don't let those go to waste, especially if you have like meaningful amounts of tax deferred assets, IRAs, 401ks, 457s, 403b, whatever. You can pull some of that forward now, either through just taking distributions and using the cash to live off of, or to turn around and reinvest into a brokerage account or something, or do Roth conversions. Either way, you are controlling the recognition of the income from your tax deferred accounts, and you're controlling the taxability of it. Like, it's on your terms. You're consciously filling up the 10 and 12% tax bracket, let's say, instead of letting this tax deferred nest egg just sit there and build and grow, such that when you're 72, you need to start taking it out. You're then at the mercy of whatever tax legislation is at the time, whatever your other sources of income are at the time. You'll have Social Security turned on by then, so your income's already going to be higher, which means the required minimum distribution stacked on top of that, meaning that much more taxable income. And then retiree specific, there's these stealth taxes like Medicare premiums known as IRMAA. Those are based off your income. All else equal, the higher your income, the more premiums you may have to pay for Medicare. It's not formally a tax, but it's functionally a tax, in my opinion. So things like that, if you can get ahead of your tax deferred balances in this tax planning window, again, typically late 50s, early 60s, after wages stop, before Social Security starts, before pension starts, before required minimum distribution start, that's the tax planning window. I'll leave it there. I can go on about that for quite a while, but thank you for the question, David Fultz. Let me just turn off my heater. It's getting warmer in here than I thought it would be. I'll be back in 2 shakes. And I'm back. I'm in a really old building that has 3 large windows that are really old and not very efficient. So there's a little space heater in here. Turn the heat on and it gets hot pretty quick. So I don't want to be sweating myself out. Okay, that's it for the 3 questions in advance. Let's see what else we have here. Trusted Wood. 66 now. No more W-2 income between 66 and 70. Is Social Security estimate for 70 fairly close at this point, or will it decrease for lack of income those 4 years? So 2 things. If you just stopped working, then yes, your benefit will be slightly overstated because the benefit estimates are based on the assumption that whatever your most recently reported earnings were, you'll continue that until you eventually start your benefit. So if you look at your estimate, the age 70 amount assumes you work up until age 70. So it's assuming you're going to keep earning, and assuming those earnings are relatively high, they may be increasing your benefit, your estimated benefit, when in actuality, if you stopped working, you may not actually get credit for that because there's no more wages. Now, what's the extent of that overstatement? It's tough to say. It depends how low the lower years of your earnings were historically, if you had any 0 years in there, things like that. If you earn fairly consistently throughout your career, chances are these few years, it's not going to make much of a difference. I mean, it's not going to move the needle dramatically. So that's one way in which the estimate will be overstated. But the estimates also don't account for inflation. So, what it's showing now is your estimated 70 benefit isn't accounting for, there will be, or almost likely will be, inflation adjustments every year between now and then. So even if you do stop working, even if you're strip out the fact that it's assuming you're going to keep earning wages. Let's not even assume that. That aside, your benefit when you get 70 is going to be higher than what it's showing you now, what it should be at 70, because there will be inflation between now and then. And your estimates don't put in any sort of assumed inflation. So like this year, or next year, I should say, benefits are going up 5.9%. So if you looked at your estimate last year, it's going to be, I'm making up a number so I can do the math easy, $1,000, let's say. Fast forward now, your estimate's going to say, $1,059 is your new anticipated payment. So all else equal, it's going to go up for inflation. So tough to say. You have to look at your actual record, Teresa, and see what the impact is. But it's quite possible that it's not going to really put much of a ding on your payment due to the fact that you stopped working. So good question. Mark Troutman with the monocle emoji. Okay. For those impacted by the SALT cap, what is the suggestion for paying property taxes in December, hoping they lift the cap retro to 2021 versus paying them in January? I have no idea. I mean, I wouldn't bank on retro. Tax code is always subject to change, always, and things can be changed retroactively. Will it? So SALT cap, for those who don't know, is state and local tax. That's where you can deduct up to $10,000 of combined state and local taxes on a federal tax return. It used to be unlimited. It's been capped at $10,000 since 2018. There's talks about it going up to, I think, 80,000 perhaps, but that's still, nothing's inked yet. There's still some Senate pushback, and the Senate is tightly divided, more so than the House. So I don't know if this is gonna get through. If it does, and it is retroactive, I really don't know. I mean, it's a gamble to try to front load or delay your taxes based on speculation about tax legislation. So I really am not comfortable kind of giving some thought here, but I would just go about your business like you always do. If you want to try to make odds on it and pay or not pay respectively, then feel free. But I'm not really. I know enough to know, like, nobody really knows how this is going to play out yet. But good question though. Oof. Have you covered Form 2210 and annualized income? No. I've discussed it. I talked about it. That's super specific and focused. Not to say it's not of interest to people, but I don't know. I mean, filling out that form isn't the easiest thing. So I haven't, and I probably won't. I definitely made reference to it, but for those wondering what this is, remember I said before to, I think, Faye's question about paying taxes through withholdings is easier, safer, and cleaner. I don't know if I used those words then, but I should have. Easier, safer, and cleaner than paying through estimated taxes, because there's no timing concept. When you make withholdings, whether you make them all on January 1st, all on December 31st, or any point throughout the year, it doesn't matter. The fact that you made them is all that matters. There's no timing element. With estimated payments, timing does matter. You're supposed to pay them in the quarters. You're supposed to pay the taxes in the quarters you realize to earn the income. Or if you have foresight enough to know your whole tax bill for the year, break that up and split it into 4 equal amounts. To the extent you don't, you may be penalized for underpayment. If you want to and need to, what's called to annualize your income, that's where you're ticking and tying the payment of like large lumpy incomes with large lumpy corresponding estimated taxes. You have to annualize your income, and that's done on Form 2210. I'm hesitant to try to show it. I mean, it's not that difficult to walk through if you have instructions in hand and just kind of go line by line, but I fear it's a little too technical in depth to try to present here, but good question. All right, David Fultz. With the 2007 tax cuts, would you comment on how chained CPI, Consumer Price Index, being used to adjust tax brackets affects how much additional tax people will have to pay moving through retirement? Bonus question, if it sunsets, does chained CPI go away? You stumped me, David Fultz. I've heard the term chained CPI. I frankly don't know the measure of CPI that goes into determining the tax brackets. Was the inflation measure different for Tax Cuts and Jobs Act, and is it due to change to something else in 2026? There's a whole so CPI stands for Consumer Price Index. There's a whole different host of ways to measure it. There's like core CPI, which strips out volatile things like food and energy, which is goofy because food and energy are important. People need them, but nonetheless, core CPI strips that out. And there's a whole bunch of like bespoke measures of CPI. So defaults, I don't know the question because I don't know what measure CPI is used in determining tax brackets, but I guess that's the nexus of the question, to which I don't know, but good one, I suppose. Olympic medals are on Schedule 1. Yeah, Olympic athletes who win prizes need to pay that, and if they get endorsement deals, they need to pay that, which is often foreign and uncommon to them, especially if they've been athletes their whole life, probably broke or close to it because all they do is train. You know, maybe they have financed by family, or maybe they get some sponsors or something. But once they get worldwide recognition and the money starts rolling in, that's all taxable, which is kind of unique to them, and they may be in for a surprise. They're technically like consultants and have to pay self-employment tax depending how they got the money. Anyway, no, you cannot avoid taxes in your curling bronze medal. Be cool if you could, though. I made a date with IRMAA for 2023, hopefully only for 1 year. Yeah, IRMAA is the income-related monthly adjustment amount, the Medicare premium surcharge. Can you speak to the stacking rules for income and investments? What is the order of stacking? Is it standard deduction, income, long-term capital gains, etc.? Am I missing something else by way of order of operations? Where does Social Security get stacked? I did do a video on this. I don't remember when. I want to say, I have no idea. Middle of this year. If anyone recalls and can share the link, please do so. It would be best to view the link because view the video because that has graphics of the stacking concept. That'll really bring it to life. Otherwise, it's going to be hard to really get across now. But let's see if I can hit it quickly. So basically, take all of your gross income, inclusive of long-term capital gains and qualified dividends. So you have all your gross income, long-term capital gains, qualified dividends are at the top. Everything else bubbles down to the bottom, including the taxable portion of Social Security. Now, you got it? So you think about all other income and then long-term capital gains and qualified dividends. Let me move your thing here so you can see my fingers. This is total gross income. And now you're going to subtract out of that your deductions. Let's assume standard deduction. So you subtract out your standard deductions, boom, okay? This stack of income drops. This stack now is what you run through the tax brackets, the long-term gains tax bracket. So if you're single, it's like 40 grand of taxable income. Any long-term capital gains or dividends within that 40 is taxed at 0. Anything above it's taxed at 15 and then at 20. If you're married, it's like 80 grand. So that's the stacking. Let me leave it there. But long-term capital gains and ordinary and qualified dividends stack on top of all of your other income. Take away your deduction, that whole stack drops. That reduced stack is what you run against the long-term capital gains tax brackets of 0, 15, and 20%. But again, check out the video on my YouTube channel. Did that much better than what I did now with this nonsense. Okay, good question though. Jill, going back to the estimated tax payments, someone mentioned before that if you took your required minimum distribution at the end of the year, the tax withholding at that time assumes you paid the tax throughout the year without penalties. Correct. Could you also throw in other income you received, like sales stocks, etc., and that amount withheld for the RMD without penalty, or each type of income is treated differently from the taxes are due? No, that's the beauty. I'll leave this up for a little bit so other folks can read it. I just get myself in the picture here. That's the beauty of withholdings. The timing doesn't matter. So, for example, let's assume it's early December and you didn't pay any estimated taxes, you didn't do any withholdings, and you got a lot of realized capital gains from stuff you sold or whatever, I don't know. And so you have more income than you thought you were going to have. Now it's like, oh man, I got to pay taxes. What you can do is you can take an IRA distribution or a 401k or 457 or whatever, and you can have 100% of it withheld as taxes between federal and or state. And that's it. Assuming you withhold enough to cover your tax liability, that withholding, even if you do it on December 31st, wipes out, or covers the whole year's tax payment for you. Now, keep in mind, while this is a cool trick, the distribution itself from the IRA or 401k is taxable income itself. So whatever taxable income you already have, if you're taking a distribution to withhold to pay it, that distribution is additional taxable income in and of itself. So you kind of have this like circular math. You have to figure out, inclusive of the distribution, how much total tax we need to withhold. But it's definitely doable. I just did this exercise literally Friday or Sunday, whatever, some point in the last few days for a client. And just confirmed today the numbers. So it's definitely doable. Withholdings are great if you can do them, if you have sources of income to use them, as opposed to estimated taxes. This is a response to Teresa's question. Is there ever an actual amount rather than a fraction of assets, like 1/3, for example, that is generally recommended for tax-deferred accounts? No. For example, for married filing jointly with a pension of $110K with cost of living adjustments and other spouse with Social Security, still 10 to 15 years from retiring and enough other assets to warrant limiting the tax deferred amounts to avoid large RMDs. No. Simple answer is no. Man, no. There's way too many parts and things to consider. Not just your own assets, but also like charitable giving. If you're charitably inclined, and you plan on making sizable donations throughout your life, making them from your IRA is really good. If you're over 70 and a half, you can do what's called qualified charitable distributions, where you can give money straight away to a charity out of your IRA that takes the place of your RMD. So you don't have any recognition of income from the distribution. You don't have to take an RMD because you're giving it away. So if you're charitably inclined, maybe you want a lot of IRA assets. If you plan on leaving the assets to your heirs, your kids, and those kids are in much lower tax brackets than you, maybe it's good to keep them so you can pass it on to them. Let them pay the tax on it instead of you paying the tax on it by distributing it or converting it while you're alive. So it really all depends. There is no single or right or best answer. Definitely appreciate the question, and it's a logical question that lots of people have, but no, it's impossible to say, especially with this amount of information. I'm not saying this isn't great info, but there's way too much that goes into this to figure out what's the right amount. And there's not, even if there is no single right amount, because a lot of this is still based on projections and assumptions, right? You have to factor in things like charitable inclinations and legacy, leaving stuff to heirs. That factors into the decision as well, but it's not as simple as saying the right number is have $637,000 of tax-deferred assets. Like anyone who's comfortable giving you an answer that specific is fooling himself or herself about their ability to predict the future. Hi, cannot get through to Social Security. Took Social Security at 62. This month I hit full retirement age. Can I suspend my Social Security until 70? Is it advisable to do so? Yes, you can suspend until 70, or it doesn't have to be 70. You can start it later. You can start it in a year from now. But yes, now that you're full retirement age, you can suspend, and you'll continue to accrue, or you'll start accruing delayed retirement credits, so that when you do eventually restart your benefit, it'll be larger. Is it advisable to do so? I'm not touching that one. Maybe it is, maybe it isn't. It all depends on your circumstances, life circumstances, financial circumstances. Yeah, I don't know. But yes, it is possible for you to suspend if you choose to. I've lived overseas for the past 30 years and I've only earned the minimum amounts for the 40 quarter credits in regards to Social Security. In this regard, I will only have 10 years of reported credits equals 40 credits, but the amount will be the minimum to qualify for each credit. Any idea what amount this would translate into for Social SSI payments? No, sorry. Great question. I do not know. There is some minimum. No, I take that back. So I forget the amount, but you only need it's like $1,500 a quarter. So that's what, like $6,000 a year, give or take, for 10 years to earn the maximum credits to get into the Social Security system. I don't know what the minimum payment amount would be for that though. Yeah, I have no idea. There's something else. There is some minimum payment if your earnings are at least a certain amount each year, more than just the minimum to get a credit, but at least a certain amount. There is some guaranteed minimum payment. I forget what it is, but if you have just the amount to get the bare minimum credits, I really don't know what that works out to. I'm going to say a few $100 possibly per month, but I really don't know. Sorry, good question. Yep, Alan Thomas. Yeah, I think this is a comment, a question. Result. Comment to another question. Do you know if there are any home office deductions for 2021 if an employee W-2 working at home? No. So only if you're self-employed can you have any deductions or deduct expenses for working at home or using your home as an office or buying supplies. If you're a W-2 employee, no, that went away with the Tax Cuts and Jobs Act, which went into place in 2018. There used to be the ability to potentially deduct unreimbursed employee expenses. So if you had to work from home and you had to pay for internet, you had to pay for office paper, and you had to pay for whatever, I don't know, stamps, Post-its. Some of it could have been deducted if that and a host of other things was over 2% of your gross income, but that's completely gone now until until further notice. Maybe it comes back in 2026. But as of now, no, there's not. Even with COVID, I would have thought this would have been one of the things they changed, realizing how many people work from home. But apparently no, not apparently, but no, they didn't make any changes. If you're a W-2 employee working for someone else, there's no deductibility of working from your home or having to buy stuff for work. Chain CPI does not sunset. Okay. Q. I want to convert 200,000 IRA to Roth IRA starting in 2022 when I retire in the spring and ending in 2029 when I turn 70 and start Social Security. Should I take that 200,000, divide by those 8 years and convert that much every year, or take a different percentage each year to convert? Doesn't matter how much I convert each year. Can't tell you what you should do, but the idea is you don't want to zonk yourself with too much income in any given year. Let me look at the math here. The other thing to keep in mind, so you're how old now? So we're talking, you're 62. The other thing to consider is once you're 63, your income will start to matter for purposes of Medicare surcharges. So when you turn 65 and start Medicare, they'll look back 2 years prior, see what your income was, and depending if it was over certain thresholds, they will charge you additional premiums. Now, not that those additional premiums should necessarily stop you from your Roth conversion plan, but that's something else to keep in mind. All else equal, maybe you want to front load it a little more. The other thing to consider is tax rates and tax brackets themselves. So tax rates now are generationally low. They were reduced as part of the Tax Cuts and Jobs Act that started in 2018. As of now, they're scheduled to go back up in 2026. That's a factual statement. Now, again, tax legislation can always be changed, but I'm inclined to say taxes are more likely to go up, not go down or stay low. So objectively speaking, what we know now with current legislation, tax rates, federal tax rates now are lower now through 2025 than they will be in 2026 and forward. So again, all else equal, that would imply maybe convert some more now in the next few years as opposed to those later years. But it's not that simple. You really have to look at the rest of your income, what it's going to do to your other sources of income. You're going to have large capital gain distributions from mutual funds or something that's going to play into it. What if you go back to work, you get bored, you get some part-time job, you get some more income there, that's going to play into it. But barring all those other things, which you have to consider, you can't avoid them. Sure, spreading it out equally in theory makes sense as opposed to jamming it all in 1 year. But again, keep in mind there are all those other considerations you have to factor in. So not a simple answer. Good question. For someone that has been collecting unemployment for 2021, do you believe that I'm correct in stating you will not have to repay any part of your premium credits no matter how high your 2021 income turns out to be? I believe that's accurate. So it's part of the American Rescue Plan Act, I think it's called, ARP, that was signed earlier this year. If you are on unemployment, I think it might be at least a week, I want to say. And I don't remember if there are other stipulations around it. But yes, if you received unemployment, let's assume it's at least a week. I don't know. I could be making that up. Then correct. There's this really nice loophole in my reading of it and other folks' reading of it. This seems to be the case, which blows my mind. Regardless how high your actual income is this year, the fact that you received unemployment means you're eligible for the maximum ACA credits, Affordable Care Act credits. So even if you got $1 million of income, you can still get the maximum subsidy / credits for Affordable Care Act insurance if you have unemployment compensation. I think it's for at least a week, but I could be wrong during the year. So yes, that does seem to be the case. And other folks who know much more than I do about this stuff agree. It seems like a really overly generous benefit. So in theory, you can do like a really large Roth conversion. That's not going to count against you for ACA credits if you received unemployment compensation this year. Now, because it impact you in other ways, it's that large conversion is still going to impact your gross income, which may ding you on other taxes, like the net investment income tax, for example. But as far as ACA, yes, I believe this is accurate. Oh, here we go. Tax Cuts and Jobs Act switched to chain CPI for tax brackets and index tax credits and other things. No sunset. Chain CPI generally increases a little bit more slowly than traditional CPI. Okay, good to know. What else we got? Is there an easier way besides going through tax returns for the last 40 years to figure out pre and after tax deductions made to a traditional IRA before doing Roth conversion? Brokerage only keeps last 7 years. Oof. No. So the question is, you made non-deductible contributions, aka basis, into your traditional IRA without backtracking every year and cobbling together what contributions you made, what was deductible, what wasn't. No, I don't have any way to recreate this. Laura Bruzis watching this. Laura just, I believe, made a comment about going through decades of tax returns to figure out her basis and clean up her Form 8606, which is the form that tracks the basis of your non-deductible IRA contributions throughout the years. She may be able to help, perhaps, if you're watching this, Laura. But otherwise, no, I don't know of any simple way to do it other than brute force of going through your returns if your brokerage doesn't have the statements and info. Yeah, it's a good point. I should have thought to say. So your broker should be able to tell you what contributions were made. The fact that they only go back 7 years is strange, but whatever. Maybe that's the case. So they can tell you your contributions, but they can't tell you what was deductible or not, and they never can. That's not up to them. That's up to you and your tax return. So they can just simply say, okay, you contributed $4,000 to your IRA in whatever, 2012. I don't even know if that amount was accurate, but the brokerage won't be able to tell you what was deductible. It's not. Only you and your tax returns will be able to do that, unfortunately. The TSP G fund will not lose money. What are your thoughts of using the G fund part as part of your stock bond portfolio rather than investing in bonds, which is tied to the market? Seems like the TSP G fund is safer, even though it will likely not gain more than 1% in general. Yeah, it could work. So TSP stands for Thrift Savings Plan. It's the 401k equivalent for federal employees. There's only 5 funds in there, I think. Really good plan. Low cost, index-based funds. The other funds in there, you can pretty easily recreate at the same or even lower fees outside of the TSP. So those aren't exclusive to TSP. What is exclusive to TSP is what's called the G fund. It's basically a kind of like a savings account. You can't lose money. I think there's one where, you can't lose money. You only get some sort of non-zero interest on it. And currently, I think the interest is 1.5% or something thereabouts. I don't remember. So yes, the question is, can this be used as sort of a bond allocation or a safe money allocation? The answer is yes. So if you're a retired federal employee, you can keep your TSP open. I think as long as you can take money out, put money in, I think as long as you leave at least $200 in there, they keep the account open for you to continue to, put in, take out. So you can use that as your kind of safe money, put some of your cash savings in there and get whatever it is, 1.5%. It's going to change over time. But the only downside is, assuming like most folks, the majority of your TSP is probably pre-tax money. So you wouldn't necessarily want your emergency fund to be in there, because when you take it out, it's all going to be fully taxable to you. And that may spike your income and spike your taxes when you don't want it to. Unlike having money in a true bank account where there's no tax to take that money out. I mean, you pay tax on interest along the way, but you're not taxed on distributions. Assuming your TSP is pre-tax money, you will pay tax on it when you take it out. So you have to plan that into your broader tax planning if you plan on keeping hundreds of thousands of dollars in your TSP, because that money is all going to be taxable, assuming it's pre-tax. But yes, that is one of the access to the G fund is one of the reasons why you'd want to leave at least some money in TSP, perhaps. Good question. Disclaiming inherited IRA question. Earlier this week, we learned that if you inherit an IRA, you can disclaim all or portion of it, but only to the other designated beneficiaries. Does this apply to disclaiming to other primary beneficiaries, or can you disclaim all or a portion to a secondary beneficiary as well? I believe you can disclaim to a secondary or contingent beneficiary. I don't think it's only other contingents. I could be wrong, and maybe it depends on the custodian, but I believe generally that you can disclaim to secondary/contingent beneficiaries. Have you used the eMoney? Yes, that is my financial planning software. How do you make sure the summation and classification of assets are accurate? How good is eMoney on tax calculations, especially state taxes? I take it this is another financial industry person, which is cool. So eMoney, and there's other things out there. eMoney is made for advisors. There's retail facing ones like New Retirement, like Personal Capital, Quicken, I think, all have what's called data aggregation. means you can link in your outside bank accounts, brokerage accounts, 401k accounts, mortgage accounts, credit card accounts, things like that. So you can get a dashboard snapshot of all of your financial stuff in one place. And generally, all these things refresh every day. More times than not, these things work, and they work really well. They do refresh daily. But like all technology, these linkages, they break. They get stale, they break, there's problems. So they're far from bulletproof, which is annoying. But I think it's better to have them with their limitations than to not have it at all. So how do I ensure clients' linked accounts into eMoney are accurate? You just have to look. I mean, there's timestamps on when was the data last refreshed, and things will break. Things will get stale. Then you either have to nag the client, hey, go refresh this, go relink the account, or maybe you just call them up and ask, give me a ballpark figure, and you type that in. So none of these data aggregators, including eMoney, are ever going to be bulletproof. You always have to keep that in mind. There will always be limitations. But again, like I said, it's still better to have it with the limitations than not have it at all, in my opinion. How good is eMoney on tax calculations? Very rudimentary. And I say that because all it knows is what tax rates are. It knows what they're going to be in 2026 when Tax Cuts and Jobs Act expires. And I think it applies some sort of inflation adjustments on the income brackets themselves. That's it. It does, it won't let you get more specific, other than you can override it and say, hey, whatever the calculated assumed effective tax rate is going to be each year, add 5 percentage points to it, or add 10 percentage points. Real sort of ham-handed, let me assume some larger amount of tax. And you can also tweak the assumed capital gains rates. That's really it. So it does run a mock 1040 through every year, but there's so many projections and assumptions that go into projecting things over 30, 40 years. It's projecting account balances. That right there is a massive, massive wild card. And from those account balances, it's projecting RMDs. It's projecting what it thinks Social Security is going to increase by. Who knows, right? It's projecting what it assumed dividends and capital gain distributions will be from brokerage assets. Those are all just assumptions. So this isn't eMoney's fault. There's just no one, absolutely no one can predict the future of tax rates, of financial market returns, of inflation, of your own longevity. The best we can do is make educated guesses. eMoney's good at that. As far as tax, like I said, it's not very granular. But again, I don't think it's in people's interest to try to get that much more granular, because they're fooling themselves thinking they can have a crystal ball to see what future taxes are going to be in 20 years. So anyway, it's good enough for what's realistically possible, in my opinion, but it's far from a robust tax planning tool. As far as state taxes, same thing. It runs through a mock 1040. I'd be hard pressed to believe that they have all the intricacies of every state's tax legislation built into eMoney. I just can't imagine they have that much, person power to program that every year, but they do. Nonetheless, the system does calculate out projected state taxes throughout the years. Again, it's just a super back of the envelope guesstimate, in my opinion. So it's a good enough starting point. Absolutely no one can tell you with granularity, how to model assumed taxes in 5 years, 10 years, 20 years, 30 years. It can't be done. Can tax credits be used to pay net investment income taxes? Oof. Hold on. Coincidentally, I happen to have a Form 1040. Let's look. So net investment income tax comes in on which line? I think, it comes in on this other taxes line. Yes. So to answer your question, tax credits can be used to pay net investment income tax. Now, it's not specifically paying net investment income tax. It's paying tax, period. Net investment income tax is part of your total tax. Against that total tax, tax credits reduce that total tax. And then what's left is what your tax obligation is for the year. So on this line right here, this is where net investment income tax would be included amongst other things. Oh, crap. Sorry. This now is your total tax. Subtract from that the amounts withheld through W-2s, through 1099s, through other forms, estimated payments made. Here's your earned income credit, refundable child tax credit, American Opportunity Credit. So yes, tax credits do reduce net investment income tax, but they reduce all tax. It's not specific to net investment income tax. Good question. Oh, yes. Now I can see your face, your Simpsonized face, David Myers. Yes. Yeah, cool. So for those of you who want your name and Facebook picture to show. There is a permission process you have to do by default. Facebook does not allow outside streaming platforms like StreamYard, which is what I use, to access that info. You don't have to. If you don't, you just get this Facebook user. If you're okay with that, completely fine. But if you want your name and face to show, you do have to opt into it here, like David Myers just did. When you disclaim, you can't say where it goes unless the beneficiary designation provides otherwise. If it goes as if you predeceased IRA owner. Yeah, okay, cool. I have very little room in the 24% tax bracket to convert Roth money. Would you convert knowing it would jump you up to the next tax bracket? This is one of those impossible to answer questions. It depends. If you have $10 million of pre-tax money and you're gonna get slammed with RMDs at some point, then maybe then maybe paying the next bracket 32 isn't a bad bet, because maybe you're always going to be in at least a 24% bracket down the road. But if you're not, let's just assume you only have at the other extreme $100,000 of tax deferred assets. Then no, then paying 32% tax on conversions likely isn't the right answer for you. So as much as all this stuff is numbers based, it's not. It's very far from an exact science. There is no quantifiable number for long-term projections of how much you should convert or how much you should have in Roth versus pre-tax versus HSA versus brokerage. Kind of the best you can hope for is to have a healthy mix. So regardless what the future holds with tax legislation and income and stage of life, you have some choices and diversification of where you pull your money from and how that money is taxed. It's kind of the best we can do. Now, year by year, yes, you can drill down to the nitty gritty. This is what I do with clients. This time now, December, I run through actual tax projections with specific figures of what we think, what their pensions were, their wages, their Social Security, their dividends, interest, their assumed capital gain distributions, and fill in what we're trying to solve for. Are we filling up the 22% bracket to 24? Are we stopping at 12? We back into what we're solving for based on what we think and what we're trying to loosely get to in the future. So year by year we get specific, but this question here goes to like, what's the broader, longer term plan for your conversions or lack thereof? Which I can't answer through this forum, but I appreciate the question. Ooh. What 2 to 3 questions would you ask a prospective tax planner advisor? Oh man, I don't know what, that's a good one. This goes back to the video we had 2 weeks ago. It's Stephen Jarvis. You kind of already have to have some knowledge about this and what you want out of it. So depending on your stage of life and your needs, is it about business? Is it about retirement? Is it about, you're young, just start a family and it's more about maximizing college savings and getting life insurance and whatever. So the stage of life will dictate the questions and the planning needs you'll likely have. But I'll assume you're referring to retirement planning stuff because you're in this group, which is kind of retirement focused. Man, I don't know. I would ask, just to pick their technical knowledge, can you explain how IRMAA works? The Medicare cert, or do you even know what IRMAA is? If so, please explain how it works. If they stumble and don't have an answer, then they clearly don't know anything about retirement taxation, in my opinion. Ask them if they know what Form 8606 is. That's the one that does Roth conversions and tracks basis for IRAs. Trying to think what else. Ask them. Yeah, I don't know. I mean, ask them if they know how Social Security is taxed. Things like that. Those are kind of the big ones that typically come into play. Ask them when required minimum distributions start, and what their thought process is to try to help minimize them if and when they think it's necessary. That's probably a good one. That'll get them going off into tangents. If they know what they're talking about, that'll get them going off in tangents about, you'll just see stuff starting to fly out of their mouth. Like information will just start spewing out because that's a pretty open-ended question. See where they go with that. Things like that are probably what I would ask. Okay, let's wrap this up fairly soon. My employer contributed $800 to my HSA in 2020, and I contributed $2,750 through weekly payroll deductions. TurboTax placed the full $3,550 on line 9 of Form 889 and listed all as employer contributions to HSA. Is that correct, since my W-2 Box 1 wages were decreased by my HSA contribution? I don't know. My gut reaction is I don't know if it matters. Because you're not getting a deduction for it anyway. Well, take it back. Your box one of your W-2 would already be reduced by the amount you contributed, right? So you're already getting credit for it there. So you don't need to separately get credit for it somewhere else. Your employer's contribution, you don't directly get credit for or deduction. So I don't know what the harm is if it all shows up as employer contribution on form 8889, because I believe, I don't know this for a fact, but I believe you don't get the deduction for it if it shows up on that line. I could be wrong. But as long as you're not getting the deduction for it, I think it's ultimately fine. If you are getting a deduction on that form, in addition to the inherent deduction you already got by your box one wages being reduced, then that's incorrect. Then you're double dipping, and you should correct that. Vicky, last spring I moved my Fidelity 401 to Fidelity and prorated, of course. 2/3 became rollover IRA, 1/3 became Roth IRA. I understand that you were only allowed one IRA rollover per year. Hold that thought, not entirely true. But if I were to transfer any fund stock from the rollover IRA to Roth IRA, is that allowed or is it a no-no? I'm aware anything that is transferred counts as taxable event as ordinary income. So what is true is that you can only do one indirect IRA rollover per year. Indirect means you take possession of the money yourself. You get it distributed from your 401k, from an IRA to you personally. You then turn around and put it into an IRA. That's allowed. That's an indirect rollover. You can only do one of those every 12 months, not per calendar year, every 12 months. After you do one, you got to wait 12 more months. But if you did a direct custodian to custodian transfer, which you almost certainly did, is my guess. I mean, I don't know for certain, but chances are you did. If you did it all within Fidelity, they almost certainly did it direct. There's no limit to the amount you can do that. So when your 401k goes directly from the 401k custodian to the IRA custodian, even if they send you a check, as long as that check isn't made out to you, if the check is made out to custodian blah 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 for the benefit of Vicky IRA, that's fine. That's a direct rollover. There's no limit on the number of direct rollovers you can do. It's only indirect there's a limit on. So to answer your question, no, if you did a direct transfer, direct rollover of your 401k to IRA, you're fine. That's not going to prohibit you from then doing a transfer or conversion of traditional IRA to Roth IRA. And Mark Troutman, bang, bang. Got it. Thank you. Alan Thomas, is there a time frame in which you have to cash out I-bonds, thinking of waiting until retirement for tax reasons and using it as an emergency fund retirement? I believe after 30 years, they stop accruing interest. So you don't have to cash. I don't know what happens after 30 years. I know they stop getting interest. So there's no point in leaving it there. I don't think. But I don't know why you would. It's just kind of sitting there, not doing anything. So 30 years functionally is when you have to take it out. I don't know if they automatically forcibly give it back to you, but there's no benefit to keeping it there after 30 years, I don't think. What is the penalty for withdrawing Roth conversions before 5 years? Are you under 59.5? If so, then the penalty is you'll have to pay 10% on withdrawing. It's not even that easy. Any conversions that were taxable upon the conversion, there'll be a 10% penalty if you withdraw prior to 5 years or turning 59.5, whatever happens first. Now, notice I said taxable conversions. If you convert money in an IRA that was already after taxed, there is no waiting period on that. So, for example, you do a backdoor Roth IRA. You have no money in traditional IRA currently at all. You put in $6,000 for this year after tax. You don't take a deduction. You immediately convert, and I'm 43. I'll be 44 soon, less than a month. So I'm well under 59.5 is my point. If I were to put $6,000 non-deductible money into my traditional IRA, and that's the only IRA money I have, I can immediately convert that to a Roth IRA, and I have $6,000 in a Roth IRA. I can take that out whenever. There's no penalty because that money was already after tax inside the IRA. There's no 5-year window or penalty on that. Where the 5-year thing applies is if the money that was converted was pre-tax and hence tax upon conversion, then you have to wait 5 years to take it out or until you're 59.5, whatever comes first. If you don't, there's a 10% penalty on taking it out. Cool. All right, looks like we're wrapping up here. I work for a foreign company with worldwide healthcare insurance, including use in the US. Is it a high deductible health plan? Can I contribute to HSA even though I'm living overseas? Ooh, I have no idea. Yeah, I really don't know. You'd have to ask your employer. I really know nothing about international matters, and specifically about HSAs. I don't know if there's a requirement that you need to be a citizen or at least resident, living in the U.S. to contribute. Check with your HR at Cigna to see. Not able to find a field financial planner. Just wanted help with questions regarding IRMA, IRA conversions, and most want to manage my account. So I guess this was in question to regards to the question of things you would ask an interviewing a tax advisor. Yeah. So the problem is that there's really not a lot of just standalone tax advisors. There's people who do tax returns, but more times than not, they're just focused on doing returns. They hang their value on minimizing your taxes this year, the year of the return, to say, look how much, look how low I got your tax bill. They're not going to do, generally speaking, they're not going to do the 10, 20, 30 year horizon and work with you ongoing to be like, you know what, maybe you should pay 10,000 more tax this year to save yourself hopefully more than 10 down the road. Usually doesn't happen. And then you have the financial planners, retirement planners who are more comprehensive. They will get involved in investments, insurance, and distributions, and Social Security and pensions. Those are more likely the ones to also incorporate tax planning, because to really do tax planning, you have to have a good knowledge of all the other stuff, all the other areas of someone's financial life. Simply doing their tax return won't give you that knowledge and insight into the client to thoroughly do good tax planning. So generally speaking, my guess is only people who are already kind of more comprehensive financial planners are going to be the ones who do true tax planning, true ongoing tax advisory. Not to say you can't find it on a standalone basis, but I think it may be difficult. Now, there may be large firms out there. I'm just thinking like what are they, Big Four at this point? The global sort of consulting and accounting places. They may have standalone tax people, but chances are they're going to be really expensive, is my guess. Not to say they're not worth it, but depending on how complex your life is and how much ultimate tax savings you're looking to hopefully get, it may not be worth engaging one of those big, top tier global accountancy places. All right, I'm going to wrap this up soon here. Okay. Can you please list a few reasons why converting to a Roth is a bad idea as long as you have the funds to pay the taxes? Secure Act made it a must-do item if you can. I cannot think of any. Ultimately, it comes down to, are you going to pay more taxes today or more taxes in the future? And it's not just taxes themselves. It's other sort of stealth things like the Medicare IRMA. That's indirectly a tax. That's something you have to account for in the future. Now, if you have a good way of somehow, knowing what the future is going to hold, and you can say with confidence, I'm going to be in a lower tax position, I'm going to be paying less tax on this money in the future than I am today, then don't do conversions. Stop. If that's your analysis, that's your results, and you're confident in it, don't do it. Because you're going to pay less in the future. Now, no one knows for sure, and that's kind of why. There's some cases where we know taxes will be higher. So I forget the specifics, but I did have a call with someone a few months ago where they already, good problem to have, but they already have, it was like well over $400,000 of income for the rest of their lives. They have a really large portfolio. Dividends alone were like throwing off 400 grand. Plus Social Security, plus I think a pension. So they're already in the 30 whatever % tax bracket. They're never going to be lower. So all else equal, we know their tax rates are only going up when the Tax Cuts and Jobs Act expires. So then the analysis is, no, they're already at 37. So they're already the top. So they're paying 37%, whatever that cutoff is. I don't remember. So their options are to pay 37 now, or wait till the tax rates go back up and pay 39.6 or whatever they ultimately go to in the future. So like, well, why wouldn't I just pay it now? Because I know objectively it's 2.6% lower to pay taxes now. Now, yes, now there's more to it because of net investment income tax and stuff like that. But point is, that's a fairly black and white example of where it's clearly they know they're going to pay more taxes in the future than now. So do conversions now. That's pretty clear. There's not really so many clear scenarios where taxes are higher today than they will be in the future. If it is, that would prevent you from wanting to do conversions. Then conversions are a bad idea. Not necessarily bad, but maybe not the best idea. So it all comes down to that. Now, there's so many moving parts and assumptions that go into trying to figure out, are taxes higher now or in the future? But that's ultimately the core of the decision. Do you think taxes are higher now or in the future? That'll help you figure out when you're going to do conversions, and if so, how much. And conversions are also partly a hedge because we don't know the future. So by paying some tax now at a known rate, you at least get it out of the way. You don't have to worry about taxes again on that money, no matter how high taxes may be, or if they go lower, whatever. You got it out of the way. You take away some of the guesswork about this. And some people like that. There's inherent value in some certainty and knowledge that I already got this done with. I can sleep better. The devil you know is better than the devil you don't, I've heard some folks say. All right. Looks like that might be it. Oh, what's this? What is this? What is this? Looks just like a follow-up. Oh, no, I just did that. Sorry. This is about the HSA question. All right. Looks like we're done here. You can ask Garrett Planning Network Advisor on an hourly fee basis. So yes, this is a place that I refer people to all the time. Anyone who's looking for just kind of hourly or project-based work from a fee only. Fee only means no licenses to sell insurance or securities for commission. So you pay them directly. There's no kind of backdoor or incentives for them to sell or recommend one thing over another. Garrett Planning Network is a network of fee-only advisors, all of which have some sort of hourly-based model. So now a lot of them do have minimums. They won't take you on just for an hour of work. It'll be like a minimum 10-hour engagement or something. But nonetheless, this is probably the best spot to look for someone who does do hourly work. And on there, you can search for tax planning, tax specialization, and hopefully go about it that way, finding someone who does tax advice. Good comment, whoever said this. All right, that's a wrap for 2021 for tonight's episode. Thank you all for joining, your support as always. Thank you very much, Cody Garrett and David Fultz, newest moderator to this ragtag bunch of, not even bunch, this small little group, not so small anymore, group of folks. I sincerely hope you all have a great holiday season, a happy, healthy, safe one. And I will see you in 2022 back with the lives. We're going to have a bit of a revamp to the schedule. There's going to be a little more structure to it. Super excited. I'm still finalizing the schedule. I'll try to get out at least the first 5 or 6 months of next year's schedule before the end of this year. But be on the lookout for that. Until then, I will see you all in the group. And again, Happy New Year. Take care. It's been a pleasure.